Welcome to the 95th episode of Kanga Crypto News, your weekly briefing for clear and dependable updates from the crypto world. I am Kuba, here to bring you the latest developments and the stories that matter most. Before we begin, a quick reminder. Everything you hear on Kanga Crypto News is researched and prepared by expert Kanga analysts using reliable sources only. However, this is not an investment advice. We release new episodes every Friday. To stay on top of the most important moves in crypto, subscribe to the channel and tap the notification bell so you never miss an important update. And now, let's get into it. So let's start with one of the most extraordinary exchange incidents in recent years. On February 7th, South Korea's Bithumb accidentally credited users with approximately 620,000 BTC during a promotional campaign error. At market prices at the time, that represented over $40 billion in BTC. The mistaken distribution triggered immediate selling pressure as some users attempted to withdraw or liquidate the funds. Bitcoin dropped sharply, with intraday losses reaching double digits. The exchange later confirmed internal system flaws were responsible for the error. Authorities in South Korea reacted quickly. Financial regulators called for stricter oversight and stronger internal controls at crypto exchanges. The incident intensified discussions about operational risk in centralized platforms. Beyond the price shock, it highlights that infrastructure risk remains one of the biggest structural vulnerabilities in crypto markets. Even in 2026, a single operational failure can shake global liquidity. Now, let's zoom out to the broader market reaction. Here comes the institutional layer. Spot Bitcoin ETF assets fell below $100 billion after fresh net outflows of roughly $272 million during the period. Earlier, strong inflows appear to be cooling as investors reduce exposure. While ETFs still hold a substantial share of circulating BTC, the direction of flows matters. Slowing demand or consistent outflows can amplify price pressure during volatile periods. This reinforces the idea that ETF flows now act as a major transmission channel between traditional finance and crypto price action. Sentiment metrics reflect the distress. The Crypto Fear and Greed Index dropped to 9, firmly in extreme fear territory as Bitcoin touched multi-month lows and investment products recorded fresh outflows. A reading of 9 is historically associated with intense risk aversion and forced positioning rather than calm portfolio rebalancing. While extreme fear does not guarantee a rebound, it often marks periods of maximum emotional pressure in the market. Extreme fear does not predict direction on its own, but it often coincides with peak emotional stress in markets. Despite the turbulence, not everyone turned bearish. Bernstein analysts reiterated a $150,000 Bitcoin target for 2026, arguing that the current downturn reflects psychological pressure rather than structural breakdown. They describe this phase as a confidence shock rather than a collapse in long-term fundamentals. It is important to stress that price targets are opinions, not guarantees, but they show that long-term narratives around BTC as a macro asset remain intact among some institutional analysts. Finally, regulators in South Korea signaled tighter scrutiny of exchange operations following the Bithumb incident. Expect stronger compliance requirements, capital rules, and system auditing. Episodes like this often accelerate regulatory tightening. Overall, this week combined exchange risk, falling prices, ETF outflows, and extreme fear. Short-term, market mood was defensive and fragile, while long-term trend, institutional integration continues, but operational discipline and regulatory oversight are becoming central themes in the next phase of crypto evolution. That's today's Kanga Crypto News. If you enjoyed this episode, like, share, and subscribe to stay current with the latest news. See you next Friday.
We are Kanga, beyond crypto.